All right, let's talk about the one question that just paralyzes every single investor. When is the right time to buy? I mean, do you jump in now and risk the market tanking? Or do you wait for that perfect dip that, let's be honest, might never actually show up?
You know that feeling, right? That knot in your stomach? It's totally real. It's the classic trap of trying to perfectly time the market. But what if I told you there's a way to invest and invest successfully without having to guess at all? Okay, so to really get why timing the market is so incredibly difficult, let's meet two characters. Think of them as the ultimate odd couple that probably lives inside your own investment portfolio right now. So, on one side, you've got the dad bod investment, a solid, steady, reliable building materials company. It's like the cement holding everything together. But then, on the other side, you've got the adrenaline junkie. This is your high-flying tech fund, the one that's either a rocket ship to the moon or it's going to blow up right on the launch pad. So the real question is, how on earth do you manage both of these at the same time? Well, that's where our hero strategy comes in. It's designed to navigate exactly this kind of chaos by taking all that guesswork and, more importantly, all that emotion completely out of the equation. It's called dollar cost averaging, or DCA for short. So what exactly is it? It's actually super simple. Dollar cost averaging just means you invest the same amount of money on the same schedule, say $500 on the first of every month, no matter what the market is doing. The key here isn't timing. It's all about consistency. And this is where the magic happens. This simple approach automatically turns that scary market volatility into your biggest advantage. Think about it. When prices are low, your fixed amount of cash buys you more shares. And when prices are high, it buys you fewer. Over time, this just naturally lowers your average cost per share. It completely removes that crushing pressure to time the market perfectly. It does the work for you. All right, now we get to the really wild part. The part that's going to sound totally backwards. We're going to look at the actual math, and you'll see how a falling market, can actually be your best friend.
Okay, check this out. In scenario one, our investor is putting in $1,000 a month. The stock starts at $100 a share. But then, oh boy, it takes a nosedive. It drops all the way down to $60. Now, most people would be freaking out, right? Selling everything. But our investor, they just stick to the plan. And look at month 3. That same $1,000 buys them way more shares down there at the bottom. Then by month 5, the price climbs right back up to where it started, at $100. So, after all that drama, all that stomach-churning volatility, what's the final return? A whopping 20.5%. Now let that sink in for a second. The stock price ended up exactly where it started, but our investor is up over 20%. Why? Because they automatically bought the dip without even thinking about it. All right, now let's flip it. Let's look at what feels like the perfect scenario, right? The stock starts at $100 and just goes on a tear. Up, up, up. But notice what's happening to the number of shares they're buying each month. As the price goes up, that same $1,000 is buying them fewer and fewer shares. And the final return here is 18.3%. Now, don't get me wrong, that's still a fantastic return. But wait a second. That's actually less money than they made in that scary falling market. How is that even possible? It's all about one simple idea. The investor in that first scenario, they got to buy more stuff when it was on sale. That's it. They acquired more shares, more pieces of the company when the price was cheap. This strategy literally transforms terrifying market dips into these amazing buying opportunities. And that right there is the secret sauce of dollar cost averaging. Okay, so this naturally leads to the big question, the big debate. DCA versus its main rival. What if you don't have a regular paycheck to invest from? What if you've got a big chunk of cash right now, like from a bonus or an inheritance? Should you go all in at once? That's called lump sum investing. Or should you spread it out over time? So here's the trade-off, and it's a really important one. Think of DCA as taking the stairs. It's steady, it's reliable, and it shields you from the crazy storms of market volatility. Lump sum, on the other hand, is like trying to launch yourself out of a cannon to get to your goal. Yeah, you might get there way faster, but your timing has to be absolutely perfect. There is zero room for error. Let's just revisit that rising market for a second. If our investor had thrown all $5,000 in on day one, a lump sum investment, their return would have been a staggering 40%. That absolutely crushes the 18.3% they got from DCA. So this proves a simple point. If you know a market is only going to go up, getting all your money in as early as possible is the winning move. But here's the catch, right? The big, giant billion-dollar catch. Lump sum investing works best if you can predict the future. And let's be real, none of us can. DCA is the strategy for the rest of us, for the real world. It's the one that protects you from the absolute disaster of dumping all your money into the market the day before it crashes. So let's wrap this up. Let's bring it all home and figure out if dollar cost averaging is actually the right strategy for you and your financial goals. So when does DCA really shine? Well, it's an absolute game changer if you're a new investor just getting your feet wet. It's perfect if you have a regular income, like a paycheck, that you want to invest from. It's also great if you just prefer a passive, disciplined approach and you're focused on those big, long-term goals. And maybe most importantly, it's for you if you just want to take your own emotions out of the investing equation. And getting started is genuinely easy. Seriously, step 1, choose what you want to invest in. Step 2, decide on a fixed dollar amount. Step 3, set a regular schedule, maybe the 1st or 15th of every month. And step 4, and this is the most crucial part, automate the whole thing. Just set it and forget it. Let that consistency do all the heavy lifting for you. Because at the end of the day, dollar cost averaging isn't just a tactic, it's really a mindset. It's about playing the long game. It's about having patience, having discipline, and truly understanding that great things and great wealth aren't built in a day. They're built block by block, with a solid plan, one consistent investment at a time.